Sorry, it's been a while since I presented, so I'm trying to make sure all my technology is working. Hey guys, I appreciate you guys coming out tonight to listen to me talk to you a little bit about homeownership. My name is Tyler Brown. I've been a loan officer actually just since the beginning of this year. I've made the career switch from previously Lazy Dog Restaurants, where I spent time as a restaurant manager. I worked in leadership development. So I've kind of had my hands in both the corporate and the restaurant side. And sorry about that. So yeah, I'm really just here to talk to you tonight about just the basics of home ownership. Since I was 18 years old, I've been in this industry when it comes to my family. My dad's been a loan officer, my mom's been a loan officer, and now here I am becoming a loan officer. And so I truly have a passion for taking care of people, which I used to do a lot in the restaurants, and now I had an opportunity to make that transition into home ownership, or rather offering people home ownership by getting them financed. So my company I work for is called Paramount Residential Mortgage Group. It is one of the largest companies that are privately owned in the nation, which is just an awesome benefit we see and deal with our owners every single day. Not recently, because we've been doing a little bit more of that remote working, but it's pretty incredible to see a company that has such a strong culture and such an industry that maybe doesn't have the most, hospitable reputation. So I've been, like I said, doing this since January. And since then, I've joined what we call our AFS department over there, which basically allows me to work across the country with different loan officers, as well as different borrowers, people looking to get financed. Currently, I'm licensed in 12 different states, including Texas, California, Nevada, Washington, Oregon. And on a daily basis, I'm dealing with both referring loan officers from those states, as well as people who are refinancing and purchasing in those states. So it's definitely been a joy. It's been a crazy whirlwind. This has definitely been an interesting year to get into the industry, but I thought it would be a great opportunity just to kind of go over some home buying basics, because it is such a exciting market right now, and there are a lot of people our age who are kind of like looking for homes. So I really want to be able to just go over the basics today and give you a breakdown of what you might need in order to get yourself into your first home. So I kind of put together a quick agenda. Basics of home buying. I really just want to go over the basic process. I think just being comfortable with the process is a big first step. It's kind of scary when you're getting into something new. So we'll go over all the basics from beginning to end and what that looks like. Myths debunked. There's a lot of myths around home buying that I want to try to nip in the bud. And really, I'm going to focus on 3, but I want to leave a little bit of room at the end for some other questions and see if anybody else has any. And then the last couple of things are, am I ready? If you're coming on to tonight's webinar looking to potentially buy your first home, you can probably, by the end of this, ask yourself, am I ready, and answer that question confidently. I'm also going to give you an opportunity to have some material after this, as well as I'll give you my contact information in case you are ready, or if you just have questions. Really, my job is not just to help people get financing for their homes, but it's really to help answer those questions to make people feel more comfortable when it comes to their home finances, and find ways to be able to save you money. And then lastly, a little Q&A at the end. So if you do have any questions, I'm happy to answer them. I'm going to try to keep everything as high level as I can tonight, just because there is a lot of detail that can go into this industry, and there's a lot of elements, but I really kind of want to cover the basics. So if there's anything maybe a little more detailed, I'm definitely able to talk to you after class or after webinar. So like I said, home buying itself can feel very overwhelming. I think we've never done it before. There's a lot of aspects to it. There's a lot of people involved. There's a lot of questions you have. And it can feel overwhelming, but it really doesn't have to. Really, that's what my job is as a loan officer, is to help answer those questions and make the home buying process as easy and comfortable and smooth as possible. So really, the home buying process, there's a lot of pieces involved. I really want to focus on just 5 tonight. First is get it pre-qualified. Second, find a home. Third, processing, underwriting. Fourth, approval. And lastly, which is I think everybody's favorite, is close the deal, get those keys and get into that new home. So big question I get a lot of times is pre-qualified versus pre-approved. Now, when we're talking about pre-qualifying somebody, essentially what I'm trying to find out and trying to figure out what you're eligible to borrow based off of your income, your debt, your assets, and your credit history. Now, when you're looking to buy a home for the first time, or even the second or third time, you have to go through this process we call pre-qualification. And basically what we're just trying to figure out is what, based off of all these factors, you can qualify in terms of a home purchase. There is a difference between pre-qualify and pre-approval. I have some people sometimes will ask me, hey, what's a pre-qual, what's a pre-approval? Pre-qualifying somebody is really all about learning what they say, or qualifying somebody off of what they say. So if you tell me you're making $10,000 a month and you've got all this money in your bank account and you've been doing this job for 5 years, essentially that's the information that I need to be able to say, okay, great, based off of what you're telling me, here's what you pre-qualified for. Difference though with pre-approval is it's not just what you say, it's what you can prove. A lot of times when it comes to our own incomes and things like that, there's a lot of other factors involved. So when it comes to being pre-approved, what we're really talking about is being approved based off of information that's being provided. So we're talking about pay stubs, we're talking about bank statements, things that could be able to tangibly say that you are able to get pre-approved for X amount of dollars. So really what we're talking about when you're starting this home buying process isn't actually going to look at a house, but rather it's about figuring out what you can qualify for and really what you can be approved for so that you can go out confidently and start shopping and looking for that house. So a couple things that are really going to make it easy in order to help you get pre-qualified or get pre-approved is 2 years stable income, good credit history, and then funds for your down payment and closing costs. We'll go over a little bit more of this in detail a little bit later, but really it kind of boils down to three big things: good stable income, good credit history, and having enough money for cash to close. So really that's kind of your setup. You're trying to get familiar with what you can go out and start shopping for. Now it's time to start shopping. Now finding the right home is really about looking for something that just fits you. There's a lot of people out there right now that were shopping. I mean, we have got one of the busiest home buying industries that we've ever seen. People are going out and looking for homes near their houses. They're looking for homes that are close to their friends, their family, or parents. A lot of people are going out of state looking for homes. Really, when it comes down to it, there's a lot of different things that people are looking for when it comes to the perfect home for them. Some of the most common ones really are being close to your working situation, finding something that is comfortable for you, and that's going to be part of your payments, and as well as an area that you want to live in. But ultimately, one of the biggest factors at play is just being happy with the neighborhood. Now, with buying your first home, it may not be your dream home, and that's okay. There's so many homes out there, and there's so many different options for you. But really, what you want to try to find and figure out early on is what exactly you're looking for in the perfect home for you right now. Again, that's going to change a lot from the beginning process to the end. I can tell you that much. My wife and I, when we first started the process, we were looking for a big backyard. We were thinking about, we wanted a pool, we wanted to do all these things. And then we started shopping around and it changed pretty quick. Not just because, we didn't find what we were looking for, but you start to see what are some elements that you are looking for. Good sized kitchen to be able to host events or family over. If you're just looking for a nice cul-de-sac. I mean, there's so many different factors that play a role into looking for the right home. And really, you want to be able to not just have an idea of what you're looking for, but you also want to have the right team around you to make sure that everything goes well. So when we're talking about your team, what I'm talking about is really, a few sets of people. The first is a realtor. I can't tell you how much I recommend finding a realtor, especially when you're looking for your first home. Because really what they're trying to do is they're trying to help make sure it's a right fit. They're also there to help guide you, be that expert to be able to answer those questions that you may not immediately have the answers for. There's a lot of factors involved when it comes to figuring out the contract or looking for seller credits. I mean, there's so many elements. So really, big portion of your team is that realtor. They're going to be the person standing in your corner, helping make sure that you get to that home that you're looking for. And when it comes time to making that offer and trying to get that signature on that line, they're going to be the person that's going to be your best friend. Next is lending team. So that's where I come in. I'm in both what I do as well as my team is all about taking care of the financing element. We're making sure that we get all the right documents from you. We make sure we get you approved. We make sure that you have everything that you need in order to be able to close your loan in order to get into your home. And then another team that's involved is the escrow and title team. These are kind of some behind the scenes folks you don't really ever see a lot of times. Sometimes you deal with them a little bit, but really their focus is about taking care of a lot of property needs, things like your property taxes and your insurance, as well as title insurance, getting your documents together. So they really play a huge role. They're kind of some of the unsung heroes when it comes to buying your first home, and are really heavily involved. So really those are the three main players on your team, but of course no good team is really that good without a captain, which is really you. Ultimately, you make the decision when it comes to who's on your team. That question I get all the time is, hey, I'm looking for buying this house and they're telling me that I have to go with their lender, or they're saying I have to go with their realtor. No, you don't. You can pick whoever you want. If you like somebody, work with them. If it's not somebody you feel comfortable with, find somebody else. There's so many people out there you can work with, so many amazing realtors, so many amazing lenders who are there to help make sure to answer your questions and to be able to take care of your home financing needs and really get you into a good place. So the beauty of it is you get to be the boss, you get to make the decisions, and you get to be the one to decide who's on your team. So let's just say we've gotten pre-qualified, pre-approved, we've got our team together, we find that home that we're looking for, we're in contract. We've signed, we've said, yes, this is the one I'm looking for, this is where I want to live, this is the one I want to buy. Now what happens? Well, I come in a little bit more at that point. Not just me though, also my processing and underwriting team. So apologize in advance, I'm going a little bit in detail on some of these aspects and I'm going a little fast. So if anybody needs me to slow down a little bit, Diane, just go ahead and jump in and just tell me if I need to slow down. But I'm happy to go over any of this stuff a little bit further in detail. And I did leave in a couple spots to stop for questions too. So when it comes to once we've got the loan going, when we're trying to get all those factors in play to make sure that we get you financed, the processors and the underwriters are super important. Now, as a loan officer, my job is really to help work with you to get everything that we need to get your loan closed. We've also got our processors who are working behind the scenes and making sure that your file is set up and making sure that we have everything that we need to get approved. And then finally, we've got these people called underwriters. These people are the ones who basically make the decision of whether or not we can approve your loan. And a lot of factors come involved with that. Again, things like income, your debt, your assets. So what do you have in your bank account? Do you have the money to close? Credit history. Do you have a good, solid credit history? And are you showing that you're not going to be at risk if you buy this home? So there's a lot of people involved that are all working together for your benefit. They're all trying to make sure that this loan is nice and tight so that we're getting you in a comfortable position and it's essentially getting you into that home. So really, again, our job is not just to get you in a home, but also really get the loan approved. So when we talk about the next step of what happens, once we've got everything going, we've collected all our documents from you, our processor is involved and our underwriter has gone through the file. Essentially what we're trying to do is we're trying to get you approved. We want to be able to get you enough money to be able to get into that house and get in for that payment that you're looking for. There's two types of approval. Anytime that you're getting approved, there's either going to be a conditional approval, which essentially means, hey, you're approved, but here's a couple other things that we need to make sure that we're nice and solid, make sure everything is in line. Things like maybe you need to update your income statements. Maybe you need letters of explanation. I can tell you there's a lot of weird things that go on in our lives, and some of them require a little explanation when it comes to maybe our employment or maybe having to do with where we're getting our income from. There's a lot of things that you have to take into consideration, and all those factors will be taken into consideration when it comes to getting you your approval. And then another one is proof of funds. Again, it's not just about what you say, it's about what you can prove. So really making sure you've got everything that you need to be able to get your loan closed and get into your home. And then the other kind of approval we're talking about is final approval. As soon as we hear that cleared to close, final approval, you're good to go. It's a great feeling because that just means that everything's in line and we're ready to go and we're ready to finish signing the docs and getting everything funded and get you into your home. Which actually goes into the final thing. Once you're approved, it's time to close the deal. You're going to do a walkthrough with your realtor. You're going to make sure that you're comfortable with the house. Everything's in line, exactly how you've asked for. All the contract lines, everything was taken care of like you wanted. You're going to sign those final docs, which I can tell you right now, you probably are going to need to do a little hand workout because it's definitely a lot of pages to sign, but you have someone there to be able to guide you through those and make sure that everything in the loan is exactly what you wanted. And then finally, we fund the loan and we record the deal. So get the loan funded so that the person's paid to pay for your house, get into your house and get those keys and get settled in and be at home as home sweet home. Yeah, so that's really the basics of the home buying process. Like I said, I went kind of quickly, but there's a lot of more details involved and a lot of questions I'm sure that will come up. But I figured ask right now, does anybody have any questions? Awesome. All right, then we'll go straight into talking about the myths that come into home buying. So there are definitely a lot of them. And I would love to go through them all because I could probably spend a good 3 hours just going through the basic myths that we hear when it comes to buying your first home or buying any home. But I want to kind of cover the top 3 ones that come up in a lot of conversations that I have with people looking to get into a home. First one is you must have 20% for a down payment. Now, when you're getting into a home, you got to be able to put initial cash down, something that says, I'm invested in this. And a lot of times people think that 20% is the number you have to have. It's actually not true. There are options for people all the way down to as little as 3% down. What I mean by that is 3% of whatever the purchase price is, it would be what your down payment or what the down payment is. Now, it's 3% for a first-time home buyer and for a specific type of program, which I'll talk about a little bit here in a second, but there is this huge misconception that you have to have 20% of the purchase price of a home in order to get into the home, and it's not true. There are so many options, and you can go down as little as 3% for your first time, if you are a first-time home buyer. When it comes to down payments, a few of the most common ones are conventional, which would be a 3% if you are a first-time home buyer, or 5% if this isn't your first time buying. FHA loans, which is a government-backed loan, is going to be a 3.5% down. FHA is also a better option when it comes to someone who maybe is struggling a little bit with their credit, or maybe it's not perfect, but we'll talk about that here in just a couple of minutes. There's also VA loans. If you are a veteran, there are so many benefits that come with being a veteran, including 0% down when it comes to getting a loan for a home. And then also you've got these down payment assistance programs. I'll talk a little bit more about those shortly, but essentially those ones can really help you get the initial cash to close, or rather the down payment money that you need to get into that first home. So definitely a lot of options when it comes to the down payment. One of the other misconceptions that I want to kind of take a minute to talk about with this piece is actually when people are thinking about getting a home, they think about, what do I need for the down payment? There's actually additional costs though that come with the loan that you have to be aware of and really prepare for in order to make sure that you are getting all the money that you need in order to buy that house. So when it comes to any loan, there's all these different loan costs. I'm not trying to scare you by throwing all these out there, but when you think about when you're getting this loan, it's not just about what you're putting down to purchase the house, but there's a lot of people involved. There's a lot of different factors, different things such as your processing and underwriting fees. Title and escrow companies that you work with, they have money that they're looking for too. So there's fees with that, cost for appraisals, impounds, reserves, and prepaids. One of the bigger things, especially if you are putting less than 20% down on a home, are these things called impounds, reserves, and prepaids. And that has to do with your taxes and your insurance. Anytime that you are purchasing a home, you have to pay upfront the 12 months worth of insurance to make sure that your homeowner's insurance is covered. You've also got to prepare for the coming months when you owe property taxes and when you need to make the next insurance payment. So those are things that we call impounds or an impound account that you build, which is essentially the escrow company holding money for you so they can make those payments for you. But you've also got things like prepaids, which could be taxes that are due at the time that you finish.
Tyler, we did get a question in the chat about what are some of the perks of being a first-time home buyer. I know you started to get into that too. So if you have any additional stuff for that, and also FHA, I don't know if it's what's FHA or if that's the same for them.
Yeah, sure. So when it comes to being a first-time home buyer, one of the benefits is you do have that option for if you have good credit, good income, going with that conventional mortgage and being able to get a 3% down versus a 3.5% down for an FHA. Other things include, depending on the company you're working with, some companies do offer benefits for first-time home buyers. There's also local and state benefits. There's really not a cookie cutter first-time home buyer program. That is kind of a misconception too, but there are different programs that you can go with that do offer benefits. There's also additional things like, I know a lot of companies offer, and one of the things that we offer is first responder credits. So you or a spouse, whoever's buying the house with you, is in is a nurse, is a firefighter, is in the police. Those are additional benefits that can come in where there be like a credit that's put towards your closing costs or any sort of thing like that. So there are a lot of benefits out there. They are very specific to the lenders you go with. So that is one of the bigger things that you want to make sure that you are looking for when it comes to if that's something that's important. Of course, some free money, some money put towards to help reduce those closing costs is definitely a big deal. But really, there's nothing that's set cookie cutter, I'd say, as far as first-time home buyer benefits. And then, Diana, you said that there was a question. Sorry, I don't see the.
It says FHA. I don't know if you want to confirm what FHA stands for, if it's different from a first-time home buyer.
Yeah, so the FHA is the Federal Housing Administration, and when it comes to an FHA loan, it's a government-backed loan that allows for a little bit more flexibility when it comes to credit and income qualification. An FHA loan does have some things associated with it, but essentially what it does is, back in the day, the FHA came about in order to help people get into homes. So it does offer things like for a lower credit score. Right now it's at 580, so you can get in at a 580 credit score, 3.5% down. Again, if you're doing conventional, there might be a 3% option if you are a first-time home buyer. But then if it's your second time or third time, it's also the option of being able to do the 3.5% down, which definitely is helpful if you don't have a whole lot of money to put down on a loan. So FHA, and then there's conventional. Conventional is more of your standard Fannie Mae, Freddie Mac products, but essentially you're looking at 3% down for that, or 5% if you're not a first-time home buyer. Did that kind of answer the question? Sorry,
I think that got it. And then we have another one. Do you need to have the money for these costs ready up front? And you should have at least 7% ready?
Ryan, that was a perfect segue, and you're exactly right. So that's one of the big things that you got to be aware of when you're getting into buying your first home is it's not just the down payment. So you're not just looking at the 3%, 3.5%, whatever it is that you're putting down. You also got to take into consideration things like these processing and underwriting, title, appraisal costs, impounds. These are all fees that kind of are associated with getting a loan. So those are all things that you want to have ready. And generally, you're looking at 2.5 to 3.5% of your loan in terms of those costs. So it's a great idea to be able to have a little bit of that extra money. You're not just putting down that initial down payment. You also want to try to have those additional pieces as well. A couple other ones that come up is the UFMIP. So I'm sure if you've owned a home or ever heard about, having a home, there's these things called mortgage insurance. When it comes to getting a home, mortgage insurance is something that you will end up seeing if it is something you're putting less than 20% down on a conventional loan, or if you get an FHA loan. So again, benefit of getting an FHA is you don't have to necessarily have as good of income or credit to qualify. However, you've got this thing called upfront mortgage insurance and a monthly mortgage insurance that can be tacked on to the loan. So it's a little bit of an extra cost. Essentially what the mortgage insurance is doing is it's actually protecting the lender or the servicer. So think about it this way. If I'm putting 3% of a house payment or the amount that I'm purchasing this house for, I only put 3% down, I've only got a little bit of skin in the game. And if I decide one day, you know what, I'm not going to make my payment anymore, I'm not going to do anything like that, then all of a sudden, here's this lender, this person who has all this money invested in that you're paying every month, having this house that, they're kind of, I won't say stuck with, but essentially. So basically what the mortgage insurance is it's a requirement for any house that has less than 20% down on when you purchase the home. For FHA, it is a little bit different. Some of that money is more for, because it is a lower income or a lower credit score, what you're doing is basically the lender's taking on a little bit more risk. So the FHA requires, and the FHA is government's taking on some risk too, because it's a government-backed loan. So they end up having this mortgage insurance that they require as part of the loan in order to ensure that they're basically balancing out their risk, if that kind of makes sense.
And we have Lisa asked, how much should you have in cash reserves to show you have liquidity? And also, what is the best way to get the credit score evaluation without lowering your FICO score?
Yeah, so really when it comes to reserves and liquidity, it just depends on what you're trying to buy. Really, if we're looking at that idea of, let's just say it's 6.5%. You're looking to buy for 6.5% of whatever the purchase price is. So in terms of having that money, it's good to have that. Personally, I would recommend having a little bit extra because you never know. Getting into a first-time home, especially if you're going into a fixer-upper, there might be a need for maybe some repairs or anything that you want to do. Maybe you just don't love the kitchens. You want to go in there and make that adjustment right away. So as far as having liquidity, it's not a bad idea to have the extra, but it really is depending on what your purchase price is or what house you're buying. And then as far as credit score evaluations, we'll talk a little bit more about credit score here in just a minute. But essentially, Credit Karma and things like that are definitely a lot of tools that I know a lot of people I work with use. And those are always good tools just to get a general average of what your credit score is without actually having to run your credit. They're not perfect, and I'll talk a little bit more about that in a little bit, but they are definitely beneficial if you're looking for just kind of a ballpark figure as to what your credit, what your FICO score is.
Awesome, thanks. And we have one more before you get to the next slide because it's relevant to your UFMIP costs. We're talking about having a 20% down payment. So that's the benefit of having a 20% upfront payment, which you just mentioned. Also, other than less loan costs, what are big benefits of having a 20% off or a 20% down payment? Sorry for my kid.
You're good. So, really that is the huge benefit. When you're looking at 20% down, you're really saving yourself money that you're not going to ever see again. So when you think about this mortgage insurance, it's not going towards paying off the principal of your loan. It's really just going towards this additional insurance that's required. So when you think about putting 20% down, what that's doing, it's eliminating this mortgage insurance. So you're basically just paying money towards your interest rate as well as your principal loan amount. So it's gonna basically it's money that you're putting more towards paying off the loan than it is just because it's required and just because you need to have that additional level of insurance for the lender. So that really and honestly, depending on the amount of mortgage insurance you require, that could be as much as like 0.3%, which doesn't sound like a lot, but when you break that down over annual, I've done loans where the mortgage insurance is $200-300 a month on top of the normal interest, on top of the taxes, the insurance, the principal. So it's, it can add up real quick. And again, it's money you never see again. So definitely a huge benefit if you can put 20% down. But if you can't, it is something that comes with putting less down, and it's definitely an option to be able to help get you into your first home. Awesome. And then the last loan cost I have in here is just funding fees. So if you are a veteran, VA does allow for 0% down for your purchasing a home, but they do have this thing called a funding fee. And it's basically, it's kind of like, I wouldn't call it their mortgage insurance, but it's basically a fee that goes straight to the Veterans Administration. And it's something that, because they back that loan, they're looking for this upfront fee that's included with all of their loans. Now, in certain cases, depending on your VA disability situation, you may actually be waived from the funding fee and not even have to pay that, which is definitely a huge benefit. But that is definitely, the funding fee itself can be a lot less than what you might pay for all the different monthly mortgage insurance as well as your upfront mortgage insurance. So a lot of different costs involved. And I'm not saying this to try to scare you guys. I like to just prepare people because when I have conversations with people who are looking for homes for the first time, a lot of times there's this misconception that it's just going to be, the 3.5% or 3% down, or even just the 20% down. But then there are these additional costs that are associated with it. So you always got to consider those before you're ready to start making offers. So, first tip I would give somebody if looking for their first home is start saving now. It's a very simple tip, but I think back to my days as a server and a bartender, and I definitely spent money where I probably shouldn't have spent some money. But I've dealt with borrowers or people who are getting homes who they bought their first house at 24, 25, and I'll tell you that's not a whole lot of people are doing that these days, and it's just not because anybody's doing anything wrong. But housing prices, of course, are a little more expensive right now than they used to be. Cost of living, all those types of things. But it's a great idea to start saving now. You just put a little off to the side just to kind of start building that foundation so that you can maybe be in that place where when you are ready to buy, you have a little more flexibility in the houses that you look at. All right, so that was myth number one. Myth number two, and this is one that you probably hear more when it comes to refinancing a home than maybe purchasing a home, but I have heard it a couple times recently, and it's something, it's a kind of a big misconception. Myth number two is some lenders offer no closing costs. I can tell you right now, no matter who you go with, and I won't name names, but there are so many different people out there, banks, lenders, online lenders, that say, we don't charge you any closing costs, we don't put any fees in there. It's just not true. The truth is, and the reality of it is, there are no such thing as closing costs. The money comes from somewhere. That is something, whether they build it into your interest rates, whether they build it into the loan cost on the back end, it's going to be there somewhere. So just, you have to be readily aware of these things when you kind of go into either purchasing a home, and for those who own a home, refinancing. So something I like to point out a lot of times, especially when someone comes to me and says, hey, I got this deal from this other lender that says they'll give me this much money and this interest rate and all these things, is the difference between an interest rate and an APR. So when we're talking about interest rate, we're talking about the annual interest paid to the principal loan amount. So if I borrow $500,000, we're talking about that interest on that $500,000. Now, when you start going through your documents and start comparing and saying, oh, there's no closing costs, I don't see any of these things in there, that's when you might start heading over towards your APR, because what APR is, it's the annual cost of the loan, including interest rates, any fees, any mortgage insurance. So essentially, it's all this stuff that's built in to the loan that is kind of being hidden away that you don't see. So a lot of times what you'll see is if someone says, hey, there are no costs with this loan, or you'll see an APR that's significantly different than your interest rate. All of a sudden you'll look at it and say, hey, I have a 3% interest rate. And then you're like, oh, I have a 3.75, 3.85, 4%, my APR. And that's because all those fees are built in there somewhere. And again, I'm not saying this to scare you guys that, oh my gosh, there's all these fees involved and all these things. I love being upfront. I love talking about these things with people. because no matter what, they're out there, and every loan you have is going to be using some sort of fees or something associated with it. Things like reserves and your impounds are things that are generally essential. There are some exceptions to that. Title and escrow fees, those are fees that just you can't get away from. People need to be paid for their work, so those companies are coming in and have those fees involved. But really what I like to explain a lot of times when I do see those things where it's, hey, there's zero fees, or these are lower, or this and that, is, hey, let's take a look at the APR, because they may not be saying upfront what their fees are. They may just be figuring out how to put that in the loan somewhere. And when you see that APR and then there's a significant difference from your interest rate, you have to start asking questions and start worrying. So really the second tip I'm going to give anybody, and this is going to apply to just about any loan if you're buying for the first time or refinancing, is ask a lot of questions. There are so many little numbers and so many documents and so many things involved. And if you don't have somebody, a loan officer or a lender, who's willing to talk to you about every single one of those items and explain where it came from, you probably need to start looking somewhere else. There's so many little elements involved, and really it's important for, especially me as a loan officer, to be as upfront as possible and say, here's where this cost comes from, here's why it exists, and be able to kind of break that down for you, because having that upfront, honest conversation, making sure you're fully aware of what decisions you're making, especially with the biggest decision, or one of the biggest decisions you'll ever make, especially for an investment, you have to be able to have your questions answered. So don't be afraid to ask questions. Again, you can start working with one lender, you can start working with one realtor, with all these people, and decide, you know what, I don't want to do this, and that's totally okay. That's another thing that I'd have people who will start working on buying a home with somebody and say, you know what, maybe this isn't right for me, or maybe they start asking questions. And then they reach out to me and say, hey, I've already started this, and I'm not sure if I want to continue. That's okay. You can say no. You are in charge. You are the boss. You can make these decisions. So if someone says you have to go with this particular person, or there's no other way around this, it's okay. You can reach out to somebody else. You can ask questions. It's your money. It's your decision, your life. So definitely be comfortable with asking lots and lots of questions. All right. And then the last misconception, this is actually something we kind of talked a little bit about earlier, is you have to have perfect credit to qualify. You don't have to have perfect credit. I don't know many people who have perfect credit. When it comes to credit, there are varying degrees of scores. Really, there are programs out there for several types of credit. Do you have to have good credit? Yeah, I would say you definitely do. It's a very strong benefit to you. There are programs out there that don't necessarily use credit, but those are a little bit less traditional, but it is an option for you. But there are different types of credit programs available out there. And just to name a couple, so conventional, like I talked about earlier, that's going to be basically your most standard loan, generally 30-year fixed interest rate, real basic. And with those ones, that is a 3% for a first-time home buyer for down payment, and then 5% if you're not a first-time home buyer, for your down payment. You've got your FHA, which is a little bit more flexible. So for conventional loans right now, it's 620, at least for us. We're using a 620 FICO score minimum that you have to have. When it comes to FHA, you're looking at 580 for your FICO score. VA, I believe right now we're working off of 580 as well. And then down payment assistance programs. Down payment assistance programs might be good for somebody who maybe doesn't have as great a credit. A lot of times the down payment assistance programs do require a little bit of a better credit. I've seen them range from about 600 to 660. So again, you don't have to have perfect credit by any means. You can have good credit. Another thing, and this isn't necessarily a loan program, but I figured I would throw it in there, is a lot of times when you're buying a home, gift funds might be an option. You might have a relative or somebody who can help you get into that home. And when it comes to down payment, a lot of times, a lot of programs offer or allow you to use gift funds, where someone can give you that money to help you get into their home. So when you think about it, you don't necessarily, you're not alone in this a lot of the times. So again, lots of loan programs out there. I mean, I couldn't even start naming the amount that are out there, because To be honest with you, I'm not even sure myself. I know for every state, or most states rather, have their own down payment assistance program. There are also variations of some of these programs that offer someone maybe with a lower income that's looking at an area to get better interest rates or to have less costs associated with it. I mean, there's so many programs out there. So something I can definitely recommend is if you're looking to buy, be okay asking, what program is right for me. When I got into this industry, my mom, who is just the most phenomenal loan officer, just because she cares so much about people and she just knows this industry inside and out, started talking about loans as loans and people as puzzles. So when you think about, when I'm working with somebody, I'm looking at them as an individual. They're not cookie cutter. You are someone who has a life, a family, you have your certain income, you have certain credit, you've got just tons of little elements involved. Really, as a loan officer, it's my job to take all those elements and put it together to this beautiful picture, which is essentially your home. So, like I said, credit score, it doesn't need to be perfect, but a lot of times, especially with the more standard loan programs, it does matter. So it is something you want to be at least comfortable at talking about when it comes to, again, looking at, keeping an eye on your own credit. There are definitely programs out there and apps you can use that'll give you a rough idea. I know, at least for Chase Bank that I bank with, they have some version of like a credit, you would call it. It kind of keeps track of your credit and kind of tells you where you're at. But when it comes to credit score, and this is something is important to know, is that it's not one size fits all, especially when it comes to the type of thing you're trying to buy. So when you're trying to buy a car, or when you're trying to finance maybe a credit card, or maybe just get furniture for your house and you do some sort of financing, those affect your credit in different ways, and they look at different aspects of your credit. There is more of the consumer credit report that is like your general credit, which usually is that Credit Karma, and it looks at all these different factors. But essentially, I really like this breakdown of the FICO score, just because it has a good amount of factors, good breakdown of the factors that really impact your credit. Essentially, what credit score is, it is a snapshot of your current and past credit history. It does help me as a lender to be able to kind of determine your spending habits, as well as what you're able to qualify for. When you have a better FICO score, what that generally means is that you're probably more consistent with making your payments on time. You probably have a nice balance of open credit, but you're not maxing out every credit card. Lots of little things, but essentially what we're trying to establish is an ability to repay debt. So when you have good credit, that's basically what it's saying, is that you're really good at taking care of your debts. It does, impact both your programs you qualify. It also impacts your interest rate, and I think that's kind of something that's maybe not everybody knows. When it comes to your interest rate, there's a lot of factors we take into consideration. And when it comes to looking at, I have people all the time ask me, it's like, oh, what interest rates are you giving out right now? Well, I'm not giving out any interest rates. There's actually a wide range of interest rates based off of what it is, your particular situation. Going back to that idea of the puzzle, maybe it's how much you're borrowing, as well as, your FICO score, as well as maybe the type of property you're buying. Maybe you're buying an investment property, it's your second home, or something like that. Those all play a role. Maybe you're buying a manufactured home, something that's on like a foundation, or maybe you're buying a condo. All of these elements kind of impact, the interest rates themselves. So it's really important to ask these questions when you're kind of getting into the initial buying process, because they will play a role. So sorry, I kind of tangent a little bit there from credit scores, but if it is the case that you feel like, your credit could be better, feel free to reach out to your credit repair companies. There really are a lot of great options out there. I'm not going to say every company out there is perfect. I definitely can't speak for all of them. One that my company uses a lot is called Get Credit Healthy. And that is one that I personally have not had a chance to use yet with people I've worked with. However, I've heard amazing results. But if someone's telling you, hey, come over here, pay us $500 and we'll fix your credit in 2 days, I would start asking some of those questions, because, stuff like that doesn't happen overnight. So there's a lot of different ways to help get your credit healthy and get it maybe a little bit better, so you can qualify for a specific program, or maybe you can get a lower interest rate. So last tip I have in regards to, this is reach out and get more info. Again, everybody has an individual situation, and I strongly recommend, if you just want to know maybe what you qualify for, maybe you are curious about your credit, how that applies to getting a home, whether you're looking for a program for a first-time home buyer or you're looking to refinance your own home, it's all right to ask questions and to reach out. I talk to people all the time about their home finance situations, and I have no expectation out of that. I really want to be able to teach and to help educate and give people the tools necessary to be successful in taking their own financial home finance situation and feeling comfortable with that. So it's okay to reach out. It's okay to ask questions. People aren't going to say, okay, well, you called me, so you definitely want to do business with me. I had a 30-minute conversation today with someone that I've known for 15 years, and I've never asked to do any sort of loans or work on their house or do any of that stuff. And they reached out just to ask questions. They were just curious what's going on, and that's okay. We want to be able to help you and guide you to be able to make the right decision that's perfect for you and your family. So it's okay to reach out to get more information. I promise you, I don't bite.
Thanks, Tyler. So we have a question in the chat. So are lenders using FICO score rather than, say, Experian? And is that a lender choice or a standard?
So when it comes to the credit that we are pulling 3 different credit bureaus. Experian is one of those credit bureaus. And we're basically taking those 3 scores and getting your mid-average score in order to determine which one we're using for qualifying purposes. When it comes to the credit score itself, we're actually looking for more of a mortgage-specific credit score. We know, obviously, if you never owned a home before, you're not going to really have any credit history on paying for a home. But there are factors that they've figured out, and people way smarter than me have figured out that help us determine when it comes to owning and paying for a home what that FICO score looks like. So yeah, generally any standard loan that you're going to be doing is going to be 3 different bureaus, and we're going to be pulling the mid score from those 3 bureaus.
Thanks. And also, what's your thoughts about getting a manufactured home as a starter home? And I've seen 3-bedroom for about $200K, but there's catches, right? And this is $200K in LA County.
So that's a good question. Manufactured homes, there are fewer programs that allow you loan programs for those. You can't always use just the standard loan programs because they don't cover manufactured homes. There are specific programs out there that do and that will lend money for manufactured homes. But there are also downsides in regards to your interest rate's not going to be as good for a manufactured home. There are, when it comes to qualifications, might be a little bit more difficult depending on your situation, but and there's additional fees that are associated with it, things like IPTS fees that you have to pay on top of everything else. So it's not a bad idea. But at the same time, though, it's not going to be the same loan that you're looking at if you were to buy like a single family home. Same thing applies to things like condos, even things like a duplex. I've talked to people who are looking to buy a duplex, the little 2-for houses, and there are different programs for those, and there are different factors that affect the interest rate and the fees associated with those as well. All right, so I know that we've got just a wide range of people on a wide range of experience, and homeowners and non-homeowners, and so I just based off of everything I'm talking about here tonight, really what I wanted you to be able to walk away with is not just having more tools in your pocket to be able to establish, whether or not, or to understand the loan process as well as the home buying process specifically. But I wanted you just to kind of start thinking about it in case, maybe you are on the fence of deciding whether or not you're ready. Again, really 3 big factors that play a role: stable income, cash to close, and good credit history go a long way. So definitely, if it is something you're on the fence about, feel free to reach out and ask questions. I'm more than happy to talk to you about all these things. Again, no strings attached. We're not here to put you into a house you're not happy with or you can't afford. That's just not okay. So really, just be okay asking questions. Think about your current situation, and if it is something that you're wondering about, reach out. Love to talk to you. That's pretty much all I got. I'm actually really, really surprised that I didn't go over my time, because I tend to talk too much, as you guys probably picked up on. But yeah, does anybody have any other questions about home buying, home financing, anything like that? I mean, I'm more than happy to answer whatever you guys have right now. And then if it's something that's maybe a little more complicated or more specific to you, I'll share my information up here on the screen in a second so you can reach out to me.
Yeah, thank you, Tyler. We have about 5 minutes for questions. We have the first one. Just curious, is it still a thing to buy homes with cash?
Yeah, I mean, you can absolutely buy homes in cash. I can tell you there's a lot of, it's not, it definitely, not a lot of people are doing it. And there's a reason why, of course, a lot of cash involved. But yeah, I mean, people do it when it comes to buying homes. Yeah.